Hey guys, and welcome back to one of the newest shows on Whiteboard, where we break down concepts and construct them visually for you. So we're going to get right into it today with the very beginning of options knowledge, and that's a call option. So if we go to the next slide, we'll start breaking it down for you. So a call option is essentially the right to buy 100 shares of stock at a certain strike price. So this may all sound pretty foreign to you, but if you understand how purchasing stock works, then it can translate pretty quickly. So instead of buying stock outright, which we see here has unlimited upside and unlimited time involved, instead what we do is we would look at buying a call. So a call is essentially the same thing, but it's temporary. So we have unlimited upside when purchasing a call, but we have limited time. And another thing that we can point out with purchasing calls is that we don't have to choose the stock price itself. So unlike buying shares of stock where we're forced to choose wherever the stock is trading at that certain point in time, with call options and put options alike, we can choose a strike price. So we can choose in the money calls where the call option is below the strike price and stock price, or we can choose out of the money calls where it's above. So there's pros and cons for each, but if we go to the next slide, we're going to break down what we do and what can happen when we're purchasing calls. So as you can see by the graphic above here, when we purchase a call, the further the stock price goes up, the more profitable that option will be. So when we're buying calls, we have a bullish assumption, as you can see here. And just to review, being bullish means that we want the underlying stock price to go up. When we're buying calls, we also have negative theta. So if you're new to options trading and you don't know what theta is, it's basically a decay that can happen to an option over time, all else equal. So when we're buying calls, we have a negative theta decay because as our option price and as our call option decays and gets closer and closer to expiration, it loses more and more value. We also have unlimited profit when we purchase a call, and that's because there's no upside in terms of where a stock price can go. It can go to infinity, it can go to 100, it doesn't really matter. So when we're buying calls, we have unlimited upside and we have unlimited profitability because of that. However, another interesting thing about call options is that we have limited loss. So instead of purchasing stocks outright, and where a stock can go to zero, we would lose all of that potential cash right there. If we're buying a call option, we only lose the debit paid for the option. So it's going to be much less than buying stock outright. And that may be one reason why someone would look to purchase a call option instead of purchasing stock outright. But lastly, in purchasing call options, because it has a limited time frame and we don't have the benefit of owning that stock outright if we were to purchase stock where we have an unlimited time frame, it does have a low probability of success because we need the stock price to go up by a certain amount for that given period of time. And if it doesn't, then our call option would either be worth less money than what we paid for it, or it would expire worthless if it's out of the money. So if we look at the profit zone over here to the right, we can see that with buying call options, it's only profitable if it goes up, and it's not profitable if it stays the same, and it's not profitable if it goes down. So we're going to look at what happens when we're selling a call option, and we'll see how that compares to buying options. So when we're selling a call option, it's a little bit different. So in fact, it's the opposite. So if I'm selling a call option, normally at tastytrade, we look to sell options that are out of the money. So as you can see by the graphic here, we're looking at selling a call that's above the stock price. And because of that, we have a credit that we receive, and that's going to be our max profitability, as you can see by the flatlining arrow. Also, when we're selling calls, we have a bearish assumption. So opposite of buying a call, it's bearish, so we want the stock price to go down because that means that whoever we sold the right to buy shares to, it's going to be worthless. They can buy shares at a lower price in the market, so that gives us the opportunity to keep that credit that we originally received as profit. Another interesting thing about selling calls is that we have positive theta. So unlike buying calls, we actually benefit from the decay of the options price because when we sell an option, in order to profit, we have to buy it back for a lower price. So if we sell an option up here and the stock price goes down or the expiration grows near, basically we'll be able to buy that option for a lower price, and the difference there would be our profit. When we're selling calls, we also have limited profit. And that's because we don't have that leverage where we have unlimited profitability if the stock price goes up and up and up. Since we sold the option, we only can profit based on the credit that we originally received and nothing more. And another interesting thing about call options is that we have unlimited loss to the upside. So since it's the opposite of buying a call, when we're selling a call, if the stock price goes up and up, we can potentially lose that amount of money. So because of that, we have the limited profit and unlimited loss. It's going to be a high probability trade because we get to choose our strike price, and normally we choose a pretty far out of the money strike price. And that gives us the opportunity to be correct in 2 out of 3 ways, as you can see by the profit chart here. So if the stock price goes up past our break-even point, that's where we would start losing money. However, if the stock price stays the same, we get to keep that credit received as long as our option stays out of the money, and we would have 100% profitability. Additionally, if the stock price goes down, we'll be profitable as well because, like we stated earlier, if the stock price is at a better price in the market than it would be if the owner of the call option exercised the option, then they're going to be better off buying the shares in the market price as opposed to exercising that call. So we're profitable 2 out of 3 ways if we sell a call option. So let's go to the next slide and we'll break it down further. So we've got some takeaways here, and as you can see, there's a lot of things going on with options, but we can get right into it. If you missed any of our other previous whiteboard segments, you can go to the homepage of tastytrade.com, click on Find Shows at the top of the page, and then scroll down to Mike and his whiteboard. A lot of those highlighted sections there we've covered previously, so definitely check it out. But with call options, really what we want to take away is that it gives us the right to buy shares of stock at a discount as long as we're right in our directional assumption. So when we looked at buying a call option, it gives us the ability to buy shares at a lower price if we look at buying a call that's in the money. Additionally, if we're buying call options that are out of the money or selling call options that are out of the money, it gives us different ways to be profitable, and there's more availability in terms of the flexibility that we have when compared to buying stock outright. Secondly, buying a call is a bullish strategy. If I buy a right to purchase 100 shares of stock, I want that stock price to go up, especially if I've locked in my strike price or the price that I am purchasing that call at, because that means that that call option will be more and more valuable the higher the stock price goes. Inversely, selling a call is a bearish strategy, and that's because if I sell an option that's out of the money, I want that stock price to either stay the same or go down because that would allow me to keep the credit that I originally received as profit. And last but not least, longer dated calls will have higher premium value. So this pretty much stands for any contract or any type of insurance that we might be familiar with in our daily lives. So the longer I have exposure to life insurance or car insurance, it's going to have a higher premium value because there's more days until that expiration, and there's more days that I'll have the ability to be correct on that. So this has been a call option. Hopefully you enjoyed it. Thanks so much for tuning in. My name's Mike. If you have any questions at all, shoot me an email at support, or you can tweet me. But until next time, we'll see you and have a great night.
Hey everyone, thanks for watching our video. If you liked it, give it a thumbs up or share it with a friend. And don't forget, click below to watch more videos, subscribe to our channel, or go to our website at